So if you've been keeping an eye on financial news this year, you've definitely heard the triumphant story. The U.S. stock market, shattering dozens of records.
Yeah, the S&P 500's up, what, about 15% year to date?
Exactly. And on the surface, it really looks like America is leading the global economic pack. But here's the massive paradox we really need to talk about today. While the U.S. is busy celebrating these record highs, it's actually trailing the rest of the world.
It's a bit counterintuitive, isn't it?
It really is. So the question we're asking is simple, but honestly, it's crucial for your portfolio. Is America's capital market prosperity just superficial? Or maybe dangerously concentrated? Okay, let's unpack this.
Let's do it.
Our mission today is to look past those, glossy headline numbers and see what the sources are telling us is really driving performance, both here in the U.S. and abroad.
And we really need to stress just how wide this performance gap is. The MSCI All Country World ex-USA Index, let's just call it the Global ex-US Index, much easier. It's up an absolutely eye-watering 26% in 2025. That's on a U.S. dollar basis.
A 26%.
Wow. It means international stocks are on track to outperform the S&P 500 by the biggest margin we've seen since 2009, way back then.
Okay, that's a serious shift.
It is, and this performance marks a really sharp reversal from that whole decade-long idea of American exceptionalism.
Right, the idea that the U.S. was the only place to invest.
Exactly. For years, the conventional wisdom was, because of our strong tech sector economic resilience, the U.S. was the only game in town. So the core question for you, the listener, is, what specific forces are actually causing this shift? And why is this long-held belief in American dominance suddenly, eroding?
Let's start with that global picture then, because these aren't just small pockets of growth we're talking about.
No, not at all.
We're seeing massive structural shifts across, developed nations. South Korea's Kospi, up an incredible 64% this year.
64%.
Germany's DAX has jumped 22%. Japan's Nikkei 225, that's climbed 24%. And even the UK's FTSE 100 is up 18%. These are big numbers.
They really are. And probably the biggest immediate structural driver making those foreign returns look so potent in U.S. dollar terms is, currency weakness, the dollar itself.
The slumping dollar.
Yeah, the WSJ dollar index has dropped about 6.3% this year. And when the dollar slumps like that, profits that international companies earn in their, stronger foreign currencies, they translate into more dollars when they're brought back home.
So it's like an automatic boost just from the exchange rate.
Exactly. It's a natural boost.
Okay. So what's driving the dollar slump then? Is it just market cycles or something deeper?
Well, that's a critical insight from the sources. It doesn't seem to be just market noise. It looks like it represents a kind of erosion of trust, maybe, in U.S. fiscal discipline. We're seeing, growing U.S. government debt. There are concerns about Federal Reserve independence. And then there's the recurring ghost of political tension, specifically the threat of renewed Trump tariffs that seems to be weighing directly on the greenback, according to analysts.
Okay, so if the dollar is making global stocks look cheaper just by translation, what about the actual price tag? Are U.S. stocks fundamentally more expensive?
Absolutely. The valuation gap is pretty stark right now. S&P 500 companies are currently trading at about 23 times their projected earnings over the next year.
23 times, okay.
Now, compare that to, say, Japan's Nikkei 225. That trades at 21 times. Or look at Hong Kong's Hang Seng. That offers an incredible value proposition trading at just 12 times projected earnings. Big difference.
12 versus 23. Yeah, that's significant. And that valuation gap, it brings us right back to that concentration risk you mentioned earlier for the U.S. market.
Exactly.
The sources point out that more than half of the S&P 500's total return last year came from just a handful of big tech stocks. It led one investment strategist to say investing in U.S. markets is, and I'm quoting here, almost becoming a one-way concentrated bet on the development and proliferation of AI.
That's a really powerful narrative, isn't it? And we should probably analyze why the U.S. has let AI concentration dominate its returns so completely compared to, say, Germany or Japan.
Good point. It's not just having good tech companies, right?
No, it's more systemic. It's about the unique structural advantages the U.S. offers, the really deep-pocketed venture capital ecosystem we have, the rapid access to massive consumer markets, and frankly, a regulatory speed that enables these enormous tech scale-ups much faster than in some other places.
Okay, so VC money, big markets, faster regulation.
It's a systemic difference that favors these kinds of giant tech plays.
But doesn't that fundamentally undermine the whole idea of U.S. market diversification? If half your returns are tied up in, like, 5 company tickers.
It certainly raises that question.
That concentration seems to be exactly why investors are starting to look outside America again, looking for bargains. And it's driven by these mounting concerns about, well, U.S. growth prospects may be slowing, the continuous trade tension, and just general anxiety on Wall Street. You hear about souring corporate loans, even the threat of a government shutdown spooking investors again.
Yeah, I think investors have finally woken up to the fact that if you want a genuinely diversified portfolio both geographically and by sector, you really have to look beyond U.S. borders these days.
Okay, let's pivot back to the States then and tackle the other side of this paradox. If the concentration risk is so severe and the global market is, crushing the U.S., relatively speaking, why is the S&P 500 still hitting record highs? Here's where it gets really interesting. What specific forces, maybe non-AI forces, are holding up the American market?
Well, the support factors are definitely there. They're undeniable. We saw stocks finishing strong recently because of genuinely strong corporate earnings, and importantly, earnings growth that expanded beyond just that tech bubble.
Okay, examples.
Sure, take Ford. A classic non-tech giant. Their profit more than doubled in the third quarter. That caused its shares to jump, 12%?
Wow, okay. Ford.
Or look at International Business Machines, IBM. Their stock leaped almost 8% after they beat Wall Street estimates.
So old school tech and old school industry doing well.
Exactly. The optimism seems to be genuinely bleeding beyond just the, Magnificent Seven AI giants. Investors were buying a whole array of non-glamorous companies. We saw lithium producer Albemarle getting bought, defense contractor General Dynamics.
Oh.
As one portfolio manager put it, Ford is by no means a really sexy name at this moment, but they've been able to deliver free cash flow and volume growth.
Right. Not sexy, but profitable.
And that signals that maybe broader economic health is returning, or at least holding up, even if AI still grabs all the headlines.
We can't forget the macro climate, right? Inflation and interest rates.
Absolutely critical. We got some encouraging CPI data recently. Yeah. Inflation up 3% year over year in September, which was actually less than expected.
Good news on inflation is always good news for stocks.
Always. And that helped stocks end the week on a high note. It really reinforced the market's conviction, or hope maybe, that the Federal Reserve will likely cut rates probably by a standard quarter point at its 2 remaining meetings this year.
And lower rates.
Yeah.
That's the ultimate jet fuel for stocks, isn't it? Provides a huge psychological boost, if nothing else.
Huge boost. But, the main risk hasn't gone away. It's still that concentration issue.
Back to AI.
Back to AI. While money is flowing to some of those non-sexy names we mentioned, the AI race remains the central thesis for global capital pouring into the U.S. Analysts still broadly believe the U.S. leads the world in AI infrastructure.
And you see that reflected in surprising places too, right?
Definitely. Like construction equipment manufacturer Caterpillar. They were actually the largest contributor to a big 1,000-point jump in the Dow recently.
Caterpillar. How does that connect to AI?
Data centers. The optimism reflects expectations of just massive spending flowing into building out data centers needed for all this AI development. So even industrial companies benefit.
Okay, that makes sense. And look, let's be fair here. We can't just ignore the long-haul strength of the U.S. market either.
True.
The S&P 500 climbed, 225% over the past decade?
Yeah.
That far outpaced its European and Asian peers.
No question, the last decade was America's decade.
And looking ahead, analysts are still projecting pretty decent, like 11% earnings growth for S&P 500 companies next year.
That projected earnings growth is robust, yeah.
Yeah.
But the overall U.S. economic growth picture is maybe slightly qualified.
How so?
Well, while U.S. growth is expected to slow down a bit in 2025, the IMF still projects a 1.9% growth rate here.
Which sounds okay.
It is okay. And
Yeah.
Crucially, it's still above peers like the U.K. They're projected at 1.4%, or Japan at only 0.2%, and Germany at 0.3%.
Ah, I see. So the U.S. isn't exactly stumbling.
No, not at all. It's more like it's decelerating from a really high baseline, while some of these global peers are maybe surging off lower starting points, boosted by that weaker dollar we talked about.
Got it. Okay, so we've covered the macro, the big picture, the mesoscale, the sort of market-level forces. Now let's shift down to the microscale, because those record S&P highs, they really mask some severe real-world volatility right under the surface.
Oh, yeah. Huge volatility.
If you actually zoom in on specific company results, you see absolute divergence. Market mood swings that sometimes just don't seem to make sense on the surface. Let's maybe use the media giants to show how hypersensitive the market seems right now.
Good example. Okay, look at Netflix. They reported higher profit, higher sales, even their best ever quarter for ad sales. Sounds great.
Sounds fantastic. Stock up.
Stocks sank 10%.
Why?
Because of a single expense line related to a regulatory dispute with Brazilian tax authorities. And that forced them to cut their operating margin forecast just slightly from 30% down to 29%.
A 1-point margin forecast tanks the stock 10%, even with great sales.
Exactly. A tiny haircut due to essentially regulatory complexity caused this massive stock movement. Shows how jittery things are.
Okay, contrast that with Warner Bros. Discovery, WBD, home to HBO, CNN, Harry Potter, all that.
Right. Their stock soared 11%.
On what news? Amazing earnings.
Nope. On news that the media behemoth is exploring a potential sale of all or some of its assets. They'd apparently already rebuffed 3 bids from Paramount Skydance.
So one company gets hammered for a tiny margin issue despite good performance, while the other gets rewarded for basically considering breaking itself up.
That's the divergence. Rewarded for a potential massive asset sale, it's about future possibilities versus present imperfections. Maybe.
Wild. Okay, let's look at the tech and EV space. Similar contrast.
Oh, definitely. Take Tesla. Their net income actually fell 37%, even though they had a surge of Q3 EV demand right before a federal tax credit expired.
Fell 37%. Why higher costs?
Partly costs, but the sources also report that the company's finances were hurt after CEO Elon Musk's, let's say, public embrace of partisan politics. Analysts specifically cited that as denting the company's reputation and potentially sales.
Interesting. So political controversy hitting the bottom line directly.
Seems like it. Now, on the flip side, you've got Amazon. They seem almost Teflon, right? Immune to operational failure.
What happened there?
They suffered one of the longest ever outages for AWS, their huge cloud service.
Oh, I remember that. It was bad.
It was massive, affected millions of users, delayed over 4,000 flights, knocked out major websites like the Wall Street Journal, a huge operational disaster.
And the stock must have tanked.
Closed 1.6% higher that day.
You're kidding. Higher after that kind of failure.
Higher. It seems the market just trusts their long-term growth story, especially in AI and cloud, regardless of these immediate, even quite serious failures.
Incredible. The tolerance level is completely different for different companies.
Completely. And finally, let's look at consumer retail. This one involves celebrity activism becoming apparently a key performance indicator.
Celebrity activism. Okay.
Six Flags, the amusement park company. Their stock rose 18%.
Why? New roller coaster.
Nope. Activist investors, including, get this, football star Travis Kelce, amassed a 9% stake and started pushing for changes.
Travis Kelce is involved in Six Flags.
Apparently so. Pushing for changes in marketing, customer experience. It's basically a rescue mission for a company that had been grappling with bad weather, declining attendance, broken rides over the summer.
Wait, so Travis Kelce is saving Six Flags?
Yeah.
I mean, that's the perfect example of the market volatility we're talking about.
Right.
The fundamentals are struggling, broken rides, bad weather, but celebrity activism provides the jet fuel for a massive stock surge.
Exactly. And meanwhile, you have Mattel, the maker of Barbie. Fresh off the movie's success, you'd think they'd be flying high. Stock lost 2.8%. Why? Simply because it was grappling with rising tariff costs and unfavorable foreign exchange rates. This was despite retailers actually ramping up their Q4 orders for toys.
So tariffs beat Barbie and celebrity activism.
In this specific case, yeah. Tariffs and FX headwinds outweighed the holiday orders and the movie buzz. It just shows how specific and unpredictable these micro-level factors can be.
Okay, so what does this all mean? Let's try and pull it together. Our deep dive seems to reveal that this capital market prosperity we see in the U.S., it's real in one sense, but it's also deeply fragmented.
Fragmented is a good word for it.
Fragmented geographically, right? With the U.S. trailing its global peers by the widest margin in, what, over a decade?
Since 2009, yeah.
And fragmented internally, too.
Yeah.
Those record highs are masking this profound divergence between a few dominant, often highly volatile performers, and then a vast number of, well, struggling giants or just companies facing specific headwinds.
Yeah, and the source material really shows that success, even for the most dominant U.S. companies, can be incredibly fragile. It's vulnerable to factors that go way beyond traditional PE ratios or earnings reports.
Right.
Like regulatory disputes hitting Netflix's margins out of nowhere, or political controversies affecting Tesla's brand and maybe its sales, or even major operational failures crippling AWS, even if the stock shrugged it off that day.
So you could be a trillion-dollar company and still be, taken down or at least significantly impacted by a single dispute or a bad headline or a technical glitch.
Absolutely. The stability isn't guaranteed, even at the top.
So this heavy reliance of the U.S. market on just a few concentrated sectors, mostly AI right now, and the extreme volatility we see in some of these individual giants, it really suggests that those surface-level records might be masking some fundamental economic anxieties, maybe, or operational instabilities lurking just below the surface.
Could be. The foundation might not be as uniformly solid as the S&P number suggests.
Okay, so we want to leave you, the listener, with this final provocative thought. Since these market gains seem so highly concentrated, especially in the AI sector, which tends to require very specialized skills, is this current market structure fundamentally locking out broad-based wage growth or even investment returns for the average American?
That's a big question.
How might these very narrow market gains impact broader societal dimensions? Things like the growing pressure maybe on labor markets or wealth inequality, if this economic growth isn't really distributed widely across the whole economy.
Yeah, is the prosperity reaching Main Street or just staying concentrated in these specific tech hubs and shareholder portfolios?
Exactly. Yeah. It's something to chew on.